Do you like paying taxes? Did you know that you have the option of paying your taxes now versus later? Roth versus traditional, all the answers in these cards. Welcome everybody to SWBC's Uncharted Wealth podcast, where we break down the complex financial topics into simple to understand terms to help you navigate your financial journey with confidence. I am Mike Walters. I'm a certified financial planner and a wealth advisor here at SWBC in the Wealth Management Division. In today's episode 9, where we talk about taxes now or taxes later, where we're going to be talking about the differences between Roth and traditional retirement plans. Is what everybody wants to hear about. So the basis behind this is, would you rather pay taxes now or taxes later? So I'm going to be talking about the key differences between the Roth and the traditional, when one of those might be better than the other, some common myths around them, and some planning strategies that we use in our practice. So get ready for today's episode because I am super excited about it. So we'll first start off with the basics. So starting with a traditional plan, where money that goes into a traditional 401k or IRA is done pre-tax, which means no taxes are taken out when the money goes in there, okay? The year that you make these contributions, you should be able to lower your taxable income, depending on some limitations, but you should be able to lower your income in the year that you make these contributions. Now, you're essentially kicking the can down the road, because everything that goes into these pre-tax accounts, these traditional 401ks or traditional IRAs, those taxes will be paid when you take the money out, okay? So upon withdrawal of anything that goes into this account, that's when the taxes are paid. Now, if you compare that to a Roth, where all contributions that go into a Roth are made with after-tax contributions. So think about this: when you get your paycheck, taxes are withheld and it hits your bank account, that's when that money goes into the Roth. Okay, so it's done with money that has already been taxed. Now, you don't get a tax deduction in the year that you make those contributions. However, when you go to pull money out in retirement, or what they call qualified withdrawals, you will not have to pay taxes on those amounts. Okay, now there are some restrictions with that, but that's why I said qualified withdrawals. But the idea here is you pay the taxes on the front end so that you never have to pay taxes again on the back end. So there are some stipulations with using the Roth, just like I mentioned, with the main one being income limitations. So if you make over a certain amount, you cannot make direct contributions to a Roth IRA. Now notice I didn't say Roth 401k, because that is the golden thing here, is there are no income limitations to making Roth 401k contributions. So for those of you out there who are doing pretty well and making some good money, sorry, you can't make direct contributions to a Roth IRA, but if your company plan allows for it, you can still make Roth 401k contributions. Now, how do you choose whether to do pre-tax or Roth contributions? Now, there's a couple different things that I want to kind of talk to you about in making these decisions, right? The first one would be looking at the current tax brackets and what you think the future tax brackets might be, okay? So if you think tax brackets are going to be higher in the future, then maybe it makes sense to put money in the Roth, right? Because when you go to take the money out later on, if there's higher tax brackets, well, then you won't have to worry about those tax brackets. However, if you're in a higher tax bracket now and you think you might be in a lower one later on, well, it might make sense to do those traditional contributions now so that you can get that reduction in income in this year, okay? Another thing to think about is your current age and your investment time horizon, right? So younger savers who have plenty of years to keep chugging along and saving in those accounts, well, they could benefit from those decades of tax-free growth in a Roth. Whereas if you're maybe coming up on retirement and you might be in your higher income earning years, well, then again, it might make sense for you to try and reduce your taxable income by making contributions to traditional accounts. Now, we'll talk again about these employer-sponsored plans like the 401ks. Many 401ks actually do offer you to do traditional contributions and Roth contributions, okay? you can do both. You don't have to be doing one or the other. So that's actually, we're going to talk a little bit about that later, but many plans allow you to choose both. Now, also, when your employer matches your contributions, the traditional way that is done is that they make matching contributions pre-tax. Okay, so that usually means the employer gets a tax deduction, but because of the Secure Act 2.0, they have actually made employers, they've given them the option of doing Roth matching contributions. Now, you don't really see it too often because, again, they're going to be giving up that deduction to their, when making that contribution, but the option is still there, so it might make sense for you to ask your HR or your custodian to see if those Roth matching contributions can be done instead of pre-tax. Just remember, though, if they make a Roth matching contribution to your account, that is going to count towards your taxable income. So it's gonna increase your income for the year. Now, the last part of this in how to choose between Roth and traditional is looking at what your flexibility will be in retirement when it comes to income planning. Now, because Roth offers that tax-free income in retirement, it can allow you to manage your tax brackets a little bit easier. Well, what does that mean? Well, in retirement, you're going to have some sources of income, right? So maybe it's Social Security, maybe you have a pension, maybe you're pulling from your investments, right? All those things can create taxable income. So if, let's say, you're square in a 15% tax bracket at the time, and you're like, man, I have this emergency come up, I need to take out more money to cover it, or maybe I just need more money to cover my living expenses. If you take it from a Roth, it's not going to affect your tax situation at all, versus if you take it from a pre-tax account like a 401k or an IRA, it's going to increase your taxable income, therefore possibly increasing the taxes you owe on that. Another thing that is a big pro for having a Roth is something called a required minimum distribution. Okay, so if you have any pre-tax money, whether it's a 401k, IRA, SEP IRA, simple IRA, anything like that, you have to do a required minimum distribution, or RMD for short, when you turn a certain age. Now, right now it's age 73. In 2030, it is set to go up to age 75. And what they are telling you is when you turn this age, if you have money in these pre-tax accounts, you have to take distributions out every year. Okay, there's a nice little calculation in there to determine how much you have to pull out. But where I'm going with this is if you get to that age and you have to start taking money out of your pre-tax accounts, you're going to lose some of that flexibility in being able to kind of customize your income at the time. Okay, and so Roth accounts, Roth 401k, Roth IRA, they do not have RMDs. Okay, because you paid the taxes on the front end, they don't care whether you take that money out again later on. So again, it just gives you more flexibility when it comes to retirement. Well, this brings us to the Uncharted Wealth section of today's podcast. I'm going to go through a couple of misconceptions of what people think, why they're not choosing Roth or why they're sticking with, traditional contributions. The first misconception that I hear all the time is that I am too old to make Roth contributions and it to be advantageous to where I'm at in life, right? I'm too old for it to make sense. And well, it's not always true, okay? Because there's another way to get money into these Roth accounts, and that is by way of a Roth conversion, okay? Where you're simply taking money out of your IRA or your 401k and you are placing it directly in your Roth. Now, that is a taxable event, just like I said earlier. Anytime money comes out of these pre-tax accounts, you have to pay income taxes on it. But it does not count as a contribution. It counts as a conversion. So doing strategic Roth conversions can be very powerful at any age, whether you're coming up on retirement, maybe you just retired and there's a gap between when you start taking Social Security and your income is lower. Pro tip, that's a strategy that we do with a lot of clients, but these conversions can be very powerful no matter what age you are, so it's something to still look at. Second thing that I hear is I don't qualify for a Roth. And again, I mentioned it earlier, some people just make too much money, which you could argue that's not a bad thing. You just can't make direct contributions to a Roth. Well, as I said earlier, Roth 401k contributions do not have income limitations, so you can still do Roth 401k contributions as long as your employer allows it. Now, I don't know if you can zoom in a little bit, but there's something that I want to whisper a little bit. There's something called a backdoor Roth contribution. It has to do with Roth IRAs, okay? There is a fairly complex method of doing a backdoor Roth contribution and basically bypass these income limitations. I'm not going to go through the details here because they get messed up quite a bit if you're not doing it with a professional, but there is a way to do Roth IRA contributions even if you make too much money. So stay tuned to later episodes where we might go into it, but just remember that, backdoor Roth IRAs. It's a secret. Anyways, next one is I will figure it out later. Bruh. Now, this is a common misconception that you've probably heard in many of our other episodes, but come on, stop being a silly goose. When has waiting until later ever worked out for you? I'll give you a moment to think about when it's ever worked out for you in the past. Okay, stop being a silly goose. You're wasting early years of compounding. You know, if you're a younger saver, like I said, you are wasting those early years of compounding tax-free by holding it off. Or do the research yourself. Figure out, like, is it worth doing Roth now while you're in a lower tax bracket or you know, so on and so forth. Like, just do the research or come to a professional and we can help you make the decision. Last misconception is an easy one. It's like, I can only choose one. I can only do traditional or I can only do Roth. Like, false. You can do both, okay? Now, there are limits to how much you can do in a 401k or an IRA, and those are split between Roth 401k and traditional 401k, right? So if we're talking about IRAs, the maximum limit right now is $7,000 for an individual under the age of 50, okay? But you can break that up. What if you want to do $4,000 into an IRA and then $3,000 into a Roth IRA? You can do that, okay? Same with 401ks, as long as you're staying within those annual maximum amounts. The last takeaway that I would encourage everybody to do is to consider tax diversification. Tax diversification. I don't know if there's going to be it on the screen or not, but maybe it could. But tax diversification. Consider that in retirement. Our next episode, I'm actually going to do a deep dive into one of my favorite presentations to do with clients is actually a tax diversification presentation on the whiteboard. It's going to be awesome. You're not going to want to miss it. So, brings us to the end of our episode today. The key takeaway for today's episode is that the Roth versus traditional discussion, it does not have to be about finding that perfect answer, okay? And again, that's something that I've mentioned in all these episodes so far. You don't need the perfect answer. It's about aligning your retirement saving strategy with your overall tax picture, okay? Too many times we are taught about how to save and getting into good savings habits and you know, investing and so on, but we're not really thinking about what the tax implications are going to be 10, 20, 30 years down the road. So I'm going to encourage everybody to, first off, go review what contributions you're doing. Of course, if you're not doing any contributions, go back and watch a previous episode. But if you are making contributions to your 401k or your IRAs every year, go back and make sure, hey, am I doing pre-tax contributions or am I doing Roth contributions? Second takeaway is, hey, if you think one of the others might be better for you long term and you want some guidance, go seek out a professional. Go talk to a tax advisor or a financial advisor that can help you create a plan to make sure that these decisions you're making now are going to align with your long-term goals, okay? So I want to thank everybody for tuning in to the 9th episode of the Uncharted Wealth Podcast. As a reminder, everything that I discuss here is not to be taken as tax advice, legal advice, or investment advice. Everything I talk about is my opinion, not the opinion of SWBC or the other people that work at SWBC. So like, comment, subscribe. I'm always going to recommend that you share this with your grandma or maybe another loved one, somebody that you like, or maybe somebody you don't like. We would like to have people watch this show. So hope everybody is enjoying their summer, and we will see you next time on Uncharted Wealth. Peace.
I will help you.
Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.